All righty, everybody. Welcome back. It is August 3rd. We made it to August. I know that was kind of somewhat in doubt this year. And this is your housing market update for Southern California. And again, just to remind those folks who might not have heard this, for us, that is the Los Angeles and Orange County markets, which actually encompasses about 15 million people. So a pretty big market. And this week we obviously have our normal updates, but I've kind of come up with a new graph because this is something I've been thinking about lately. I was reading something where a person was talking about the housing cycle, right? And they were talking about this on an annual basis, like what happens every single year. And it got me to thinking, Southern California is a pretty unique market. And when I say that, we don't have the same seasonality due to weather that other markets have, right? Like, so in Minneapolis, Minnesota, for example, in that market, as you might imagine, when it is snowy and there's inclement weather, their market is really subdued. And here in California, I mean, we do have, I'd say between maybe Thanksgiving and New Year's is a bit of a slower period, but we don't have nearly the same kind of seasonality. But people were talking about this notion of our seasonal market, talking about it like it's something that is to be relied upon, or that there's predictions that we could make based on that. And so I actually went back and I looked at the data because I thought that might be interesting to do. And let me pull that up here because I think the data might surprise you on this one. A lot of times for me, sometimes I'll be super curious about something, and one of the things that I do when I'm super curious, I hope everybody can like see this here. Make sure it went the right way here. One of the things that happens with me when I'm curious is I start to look for the data. I think like, okay, this is what my mind intuitively is telling me, but I wonder if the data actually supports it, because a lot of times our intuitions are actually wrong when it comes to economics and data. So what I did is this: I pulled up Orange County median home prices to make it easy for 2017, 2018, and 2019. And there's a couple really important things that you can glean from these graphs. Number one is that these graphs are not exactly the same shape. And while we do see something that shows up in all 3 years, like we notice there's some sort of springtime element where houses go up in value in all three of them. You can see that in 2019, things ran up through April. In 2017, they ran up March through May. And in 2018, they actually ran up in that springtime period through January through March. But I think what's important to understand here is that, 2 of these years we had a decline after that increase. One of those years we did not have a decline after that increase. 2 of those years we had an increase towards the end of the year. One of those years we did not. And I think what's important to understand is that, our data really is not predictable enough. And to sort of make these predictions of what the year is going to look like, if you are here in, say, March of any of these years, you would not really be able to predict what the rest of the year is going to look like. And I think that's really an important point to make. One of the things that we find people frequently do, and I think this is human nature, right? If you think about how our brains work, our brains are pattern finders. And probably even more importantly than that, they're sort of narrative creators. So our brain looks at the data and it tries to create a story out of it. And, informally, I call this seeing animals in the clouds, right? Like we all know clouds are completely random. And yet, when we look to the clouds, we tend to see animals and shapes and things. And that is our brain trying to make sense. It is trying to create a narrative and identify a pattern. But if we look at this, there's really 2 things to understand. Number one is that there's not enough data to really glean a prediction point. Probably the only thing that we could say about this data over this 3 years is it looks like in the springtime, there's usually some run up in prices at some point. That's probably the only thing that exists between all 3 of those. But there's something else that's important to understand. When people think about the value of their home going up over time, they think that that line looks like a straight graph, and it isn't. It's sort of this jerks, fits and starts. It goes up, then it stagnates for a bit, then it might even drop a little. then it goes up even more. There's really not an even pattern to this. And home prices move a lot more like the stock market than they do sort of this linear, predictable fashion, which is what kind of most people think they do. So just wanted to take a second, kind of open up with that. Something I've been thinking about over the past week because people are invariably asking me for predictions about the future. And I think I've told you, I'm not super comfortable giving you, the longer the term the prediction, the less comfortable I am making it. And, I think there's people that are going to tell you how the market's going to be the rest of the year. And I think those people they're making guesses, maybe even educated guesses, but they're guessing nonetheless. I wouldn't hang your hat on that kind of a thing. I think it's better really to take a look at fundamentals and kind of say, if these keep up, this is a chance of what we think will happen, or, this is one of the ways that this year could turn out, one of the sort of modes of what could happen. So without further ado, I'm going to kind of jump into our stats because, we talked last week about an effect that I thought we were having, and I think that's pretty much confirmed this week. And I'll tell you why. So if we go under here under our new listings, again, we've divided into under $1 million and $1 to $2 million. The good news is, I think for the market health overall, is that listings are up, right? In both of our categories, we've seen an increase in listings, and I'm sorry this is pretty faint here, but we're really not that far off the pace. We're within 5% of last year, as I'm going to show you in this next chart. We're still down based on last year, but we're down by less, right? I mean, in this case, we're only down by, 80, 85 or so, I think. 85 listings, that is less than a 5% drop. I think it's closer to a 4% off the pace of last year. So we are finally starting to see some more listings come in. Listings are up versus last week. And if we look at new escrows, we kind of see sort of the opposite effect, at least in our under $1 million category. We actually see that escrows dropped. And if you remember, last week I was talking about something. I'm going to kind of go off share here. Last week, I told you that I had a prediction that we are seeing a very, very supply constrained market. And that's causing a lot of problems, right? Because, what do you do when there just aren't enough houses? What do you do when there are 10 buyers for every 6 houses, right? And when you start to get these extremely disproportionate relationships to the number of homes for sale and the number of people who want to buy homes, well, prices go up, marketing time goes down, people settle for houses they wouldn't otherwise settle for. But one thing ultimately that ends up happening is you do start to constrain the number of sales. You actually start to see sales not going up or even retreating because there just simply aren't enough compelling properties on the market for the number of buyers that exist. And, having had a listing last week where we received 17 offers in 4 days, I can tell you that this is real. We spoke to agents who are representing buyers, and they're telling us that, this is the 10th offer they've written on a house. And those stories are not uncommon. And while I don't like relying on anecdotal data, when I start hearing the same narrative all over the place, it's really indicative of something that's kind of widespread. So I still think this data is supporting this sort of limited supply theory that our sales are being constrained by lack of inventory. Now, it's really interesting, and what I mentioned, I think, a couple weeks ago, is that I think that what we're having happen, because we saw new listings go up this week, I bet new escrows will shoot up next week, right? Because you think about it, there's a delay of a week or two. A new house comes in the market, and then it goes into escrow, right? But that takes time, usually between 4 and 10 days, even in a hot market. So if you think about that, we should see new escrows go up next week. And I'm really curious to see if that ends up happening. We're getting kind of this sort of wiener dog yo-yo effect, right? Where, the front legs move forward and then the back legs catch up. Then the front legs move forward, the back legs catch up. So I think we might be seeing that effect. If we look versus last year, we're really taking a hit here. We're almost down 300. This is actually, this is almost a 15% decline. So you think about it now, new listings have caught up, but we're seeing this weird yo-yo effect. Last week, new escrows were higher than last year. And, this is just further evidence that we're seeing this kind of oscillation happening. And just as an aside, this is kind of like a little bit of a nerdy moment for people who like this kind of thing. my degrees are in economics and physics, and you might think those things have nothing to do with each other, but you actually find when you do some of this data modeling that the economy and economics in a lot of ways can behave like physical systems. And so what we have going is this kind of situation where it's almost like this resonance or oscillation where we're going to see these new escrows kind of go back and forth. And if we look at our data on the graph and we look at our prices, we can kind of see evidence of that sort of rhythmic pulsing happening. Let me bring that up here and go back. You know, we're actually seeing this, right? If we look at this data, we're kind of seeing this funky rhythmic thing happen where it goes down, then it goes, let me get my pointer out here, where it goes down, then up, then down, then up. And we went up a lot, then down, up, then down, up, then down. You're kind of seeing this rhythmic almost pulsation of the market. And that operates a lot of the same ways, like a lot of things in nature and in physics work that way. Pendulums that swing back and forth. There's sort of a lot of things that settle into these rhythms, and that's something you see pretty frequently. Even in our $1 to $2 million category, once our markets stabilize, same thing. Up, then down, up, then down, up, then down. And you start to see this rhythmic sort of pulsation in the marketplace. Going to our absorption rate, as you might expect, our absorption rate went up slightly for our $1 to $2 million range here, but it actually went down in our under 1 million. That's of course to be expected because listings are up and new escrows are down. But we may actually see this reverse next week. And again, we see this rhythmic pulsation of this absorption rate. And you know, that's just something that you're going to kind of see in a market like this. And I think it's sort of endemic to the way the system sort of works and functions. Now let's take a look at our average pending list price. And if you remember last week, in fact, before I get to this, I was talking about sort of almost a frustration, right? Like days on market is down, absorption rate is high. Why are we kind of seeing the prices peter out? And are we going to see a little bit of a jump sort of happen? Well, let's go to the graph and see what happened this past week. We kind of redid some of these graphs, by the way, to make them a little bit clearer, easier to read. And if we come here over and we look at our latest data on this right-hand side, boom, look at this jump that we had to over a 647 average pending list price. Once again, this is under $1 million, and you'll notice we use average pending list price, and I do that because I want the most current data possible. I do not want to wait for properties to close because that data is a month old. I can't do anything. Well, I can still do something, but it is not as useful to me. If you are a buyer or seller in the marketplace, you need this information right here because this is the market you are in, not the market of, you know, a month ago. And so we kind of saw a really big jump. And just to give you an idea, I mean, this is over, this is over a 2% jump, right? Week over week. I mean, this is a big deal. This indicates that supply is just super constrained and buyers are writing whatever check they need to write to get a house. And I have another reason why that is happening. And I'm going to show you that towards the end here when we do our affordability analysis. So if we look at our list to close ratio, we see a similar story, right? If we're going back here since the beginning of May when we started running this statistic, guess what? Look what's happening. That number has really been on this upward trend line. That really is a sign that the market is getting more competitive. And we notice here that we got 100.2%. So actually, our closings right now are over list price on average. And I mean, that's just an amazing statement. That means on average, everybody is underpricing their houses versus where the market actually is. We don't show it on this particular graph, but we actually looked at the data for the last week's pendings and closings, and it's actually 100.5%. So, I mean, just anytime you see this, it means you have a market that is in an upward direction and it is moving faster. I'm actually going to say this out loud twice because I think it's important. When you see a list to closing price ratio over 100%, that means that not only is the market moving upward, but it is moving upward more quickly than sellers are realizing, because it means even as they're increasing their list prices, it's not keeping pace with where the buyers actually are in a market. And that's really noteworthy to think about in a market like this. average pending list price for our $1 to $2 million category. We actually saw a similar jump this week. If you look along our graph, we see kind of fits and starts. We actually moved back upwards into the 139s. We have a lot less data for this. There's fewer data points. So because of that, we're going to see this bounce around a bit more than our under $1 million statistic. If we go to our days on market for new escrows, we see in our $1 to $2 million, it actually plummeted below 48 days, below 40 days. Anytime we see these really low days on market, I think I've talked about this before, that I feel like this is a leading indicator of price chumps. Meaning, if you see this number low, it means that price increases are coming. And if we look in our under 1 million category, again, we are at under 30 days on market average for new transactions. That is really just kind of a mind-blowing statistic to be so low for so long. It indicates an extreme inventory shortage. And now I want to talk about something else before I show you the graph of our affordability analysis. And again, our affordability analysis really tries to give people a relative look. How expensive is housing when you take into account interest rate? So it's not just talking about median price. We're actually talking about what does it really cost for that payment for a median priced home, and how does that compare over the last 2 years? Because I think it's really important to have that sort of grand perspective. And if we go into this graph, guess what? We dropped again. We're at the lowest point since August of 2019. So we are at the lowest point in a year. We are at like 90.1%. So 90.0% of where we were in payments versus over 2 years ago. Whenever I see this, I feel like there's kind of a lot of room for sort of housing prices to grow. And that's really insulating this housing market from price drops because, in effect, the payment has dropped for housing, but the actual transaction prices have not. And there's a couple reasons why it's so important to make that distinction. Number one, you're probably noticing or asking this question, what happens should interest rates rise and rise quickly, right? What is that going to do? Well, the good news is, if they rise to some degree, we've got a lot of room to sort of take up before prices have to fall to be lower than they were 2 years ago. So, we still have a very healthy margin, but it also means, if interest rates remain low, prices for houses don't really have anywhere to go but up. We are so supply constrained like we are right now, there's not really any direction for prices to go. So as long as supply is kind of lacking and demand even just stays constant with these low interest rates, you're not going to see any price relief anytime soon. And by anytime soon, I'm sort of defining that as now until the presidential election. That's my anytime soon. So after the presidential election, I think it's really silly to make predictions at this point because, a lot of things can happen between now and then, and it would be really irresponsible. But I will tell you, we are continuing to have a very strong market, and I think that will continue through the end of the summer and through the election period. After that, I don't know. So as always, this is Stephen Mead for Domicile Real Estate for people who love houses and love talking about houses, which obviously we do in the housing market. If anybody has any questions or comments, we'd love to hear from you. And if we could assist you in any way in buying or selling a home in Orange or Los Angeles counties in California, we are here for that too. That's all. We'll see you again next week.